Welcome back to another Vessel Supply Chain Insights video. Today we have Denise Dunlap from Sage Growth Capital with us. I'll have you give your background. Oh, and we're going to be talking about capital strategy. So Denise, if you could give us your background.
Hi, my name is Denise Dunlap. I am the co-founder and managing partner of Sage Growth Capital. I have been in the entrepreneurial ecosystem for a long time. I started as an angel investor in 2008. Went on to manage the local angel funds. I also worked for Boise State running the business incubator, so I worked with entrepreneurs. And I have a business that provides services to angel investors all over the country. And then a couple of years ago, we launched Sage Growth Capital, which is a small venture capital firm that provides revenue-based funding to companies that qualify.
Thank you. And I'll point out that there is another video in which we talked to Denise and the rest of the Sage Growth Capital team, and we discussed revenue-based financing, exactly what that is and how you use that in your capital strategy. So today we're going to be talking about capital strategy, which, a lot of companies that get started and they feel like the first thing they have to do is raise money, right? That's what it's all about. I got to talk to investors. I got to raise money. So what do you say to that, Denise?
Well, the thing that I think companies all too often don't think about is they need to have a plan for what they want to do with their business and have a really good sense of what their long-term objective for that business is, because whatever that is, it will drive that capital strategy. And companies don't think about it as a capital strategy. And that's why we're using that term, is because I have personally been trying to help companies think about that in a little different way. So just like you have a go-to-market strategy or a hiring strategy or any other strategy that you might have for your business, you really should have a capitalization strategy as well. And like any other strategy, it's not going to be a one and done kind of thing, or we're only going to get bank funding, or we're only going to get investors. It needs to encompass all of the different capital options that are available to you at different points in your business, but we can talk about that later. I think that the first thing that companies need to think about when somebody starts a business is, what is my long-term goal for this? Do I want to keep it in the family, and do I want to build this up to millions of dollars and have great employees and be a profitable company and then hand it off to my kids? Or am I going for the blitz scaling, rapid growth? I want to be the next Amazon, the next Google, whatever it is, and I'm going to find an acquirer and get out. Those obviously are not the only options in building a company, but those are often kind of the ones that people think about, right? So there's a lot of things that you could do with your business, but I think entrepreneurs need to be very clear on what their goals are, because once you take certain types of funding, then you're stuck in that role. So I think that you really have to think about what your long-term goal is for the business.
Okay, yeah, that totally makes sense. So if you're a company, and I hear a lot of people say this, they say, well, I feel like I don't have to decide, right? I can make up my mind if it's a venture or if I want to do a lifestyle business later. Mm-hmm. And a lot of times they're saying that when they're taking equity capital, right? Yeah. So what do investors say when somebody says that?
Well, so first of all, if you're taking an equity investor, and for clarification, equity investor is somebody that invests in your business and gets ownership, right? So if you're a C corporation, that's stock. If you're an LLC, that's units of membership, whatever. It's some kind of ownership in your business. So I give you money, and now I own a part of you. So that's, that's the basic model, right? What all too often happens is entrepreneurs don't realize that once you have taken an equity investor, once somebody owns a piece of your business, they expect to get paid back. This is not a philanthropy relationship. They want to get paid back, and how do they get paid back? That's where you really need to think about that before you take an equity investor, because usually the way that equity investors get paid back is when you sell your business. So going back to what I said earlier, if you don't want to sell your business, you don't want to scale it and sell it, then you probably shouldn't be taking equity investors, because how are they going to get paid back? And trust me, they do want to get paid back. So to your point, you asked about companies saying, well, I don't want to decide, I need to make that decision later. once you've taken equity investors, you've made that decision. Unless your equity investors are different than the ones that I know, they don't want to take dividends. They're not interested in that. You didn't ask this question, but why? Well, this is considered risk capital. So by that, you have to think about, if I'm asking somebody to invest in my company early on, they're taking a significant risk. Therefore, their reward must be significant to make up for that risk. And so they expect exponential returns typically, right? Now, you might be lucky and find somebody that says, sure, I'm happy to invest hundreds of thousands of dollars into your company, and if you pay me back dividends, I'm happy with that. Most equity investors are not looking for dividends. They're looking for exponential growth and also a very high return, 10x or more on their original investment. So again, you really need to think about what is that exit strategy and how will they get paid back, because they expect to get paid back.
So it's really thinking about it from an investor standpoint, right? So because I'm taking a larger risk, I expect to get a higher rate of return.
Yep.
I'm not a bank. So I'm investing in your company, which is a higher risk company to get things started. And if I'm investing, I'm not expecting to get 8% return.
No, banks are taking very, very little risk.
Mm-hmm.
And that's why you can get an 8% loan or whatever the rates are now. That's why their payback is so small, because they're taking almost no risk. You as the entrepreneur are taking the risk because you're personally guaranteeing your loan. You're probably providing collateral. All the things that go along with a bank loan is reducing the risk for the bank. And so they're not expecting those high returns because they're not taking that risk.
Mm-hmm.
But equity investors are taking the most risk, so they do expect the most return.